everybody seems to be on one side, and that is negative. As hard as it may be, is it possible to see the other side? Is there anybody here, maybe aside from David Zaslav of Discovery, that has gotten it right or gotten a good deal?
Well, good morning, Brian. Nice to be with you. Look, I think you got to separate the discussion about what was done in the original merger. Clearly, there were flaws in the strategy, challenges with the execution. And so let's put that aside. I think the question is, for an investor, an employee, for a stakeholder like a storyteller, what does the future hold? And in my mind, you're going to have two stronger companies here, without a doubt. You start with they're more strategically focused. They've both got scale. And for the combination of Time Warner and Discovery, you'll have some global opportunities, which I think are going to be critical if you're going to compete with the likes of Netflix in the world. So there are going to be some challenges, without a doubt. I mean, there's Jim Cramer's comment about transformation or whatever. Look, there's going to be a lot of heavy lifting to merge these two businesses together. I recall it took 20 years really for Frito-Lay and PepsiCo really to kind of gel as an integrated entity. When that merger was done, and there's a lot of work to do in the midst of an industry that's still going through wrenching change. I mean, we are not done by a long shot with change that impacts the media industry.
Yeah, and now, of course, as these things tend to go, Michael, everybody's asking, who's next? They're looking at our parent company, NBC Universal, and our owner, Comcast. They're looking at Viacom, CBS. There's some talk. Could those two link up? Would regulators allow it if we tried? This is not 1974. There's not 3 or 4 channels out there. There's thousands of channels or apps, whatever you want to call them anymore. Who do you see next in the possible tie-up parade?
To be honest, this is a pretty unique situation where you had an asset in Time Warner owned by AT&T that clearly didn't fit. It didn't lend itself to their management capabilities or otherwise long term. When I look at the rest of the media landscape, you've got a lot of kind of smaller plays, smaller channels. And I noticed kind of Amazon may be looking at MGM, but that's a different animal too. And I'm not sure why they need a movie studio or a television producer when Netflix is able to get all that stuff done without one. But they may have the library, and that may be of interest to Amazon. But look, I think you've got some smaller plays that kind of don't have a particular compelling argument to be bought by anybody. And, you've got increasingly 4 big companies. But look, the competitive nature of this industry is going to continue to challenge each of the players on scale. I mean, you look at the amount of money that Netflix is spending on content production, I don't know, $17 billion. That's a staggering amount of money. And in particular, they can leverage it across 200 million subscribers worldwide, which is why, in some ways, the most interesting strategic challenge for all the content companies is evolving from what was largely a U.S. play to figuring out, as Netflix is doing, how to leverage the world with their content assets.
And we talk about the shows, Michael, because they're sexy. It's a lot easier to say we need content. By the way, we don't just need a lot of content. You actually need good content. It's not just about a lot of stuff. You have to have stuff that people want to watch. But underneath the hood are all the financials. That's what really matters to the executives. I think David Zaslav probably knows it as good or better than anybody else out there. We talk about the growing, changing face of cable, people cutting the cord, how subscriber, VOD, video on demand fees, all of that is evolving. Underneath the hood, how much does this deal, if at all, change the financials of the business?
Well, I mean, first you make a very important point about content, Brian, and on top of that, we're coming out of a pandemic with a lot of changes in society that content is going to have to kind of navigate through. And so let's not underestimate just going back to work or going back to normal for the entertainment industry with a content pipeline that is full and robust and relevant to consumers today is a big job for every content company out there. So I wouldn't underestimate that. In terms of the financials, look, there's 2 dimensions to it. For investors, clearly there's going to be some sorting here. I mean, you know, a lot of investors held AT&T for a 7% dividend and were fixed income and weren't looking for growth, but they were looking for a 7% return. Those days were short-lived anyway, but you're going to have some you know, kind of puts and takes in terms of the investor pool. In terms of the financials themselves, again, and it's more than David. My experience at PepsiCo,
Yeah.
you know, and I've worked in big companies and small companies. If you're going to be in a big company like a PepsiCo, which has diversified assets like Pepsi-Cola, Gatorade, or Doritos and Frito-Lay, as international as U.S., you've got to come up with management processes. You got to have a cohesive culture, and you got to have the right leadership team. It's never one individual. And I think Andy Pearson and Kendall, when they put together the company in the 70s and the 80s, really kind of took a decade getting that right. And I wouldn't underestimate the challenges David's going to have.
Yeah.
David is a world-class CEO, a world-class media CEO. He's got great relationships in Hollywood. He's going to do a terrific job. But David would be the first to tell you he needs a full team.
Yeah, you wonder where Warner Media CEO Jason Kilar, they just had a big piece, a profile, kind of a glowing piece in the Wall Street Journal over the weekend. Now, his future is uncertain. People talking about his exit. Very quickly, Michael, I'm not going to ask you to slam the guy, but, you know, you talked about AT&T and that sort of widows and orphans, 7% dividends, why you own it. I mean, you know, even as AT&T stock is down in the last 10 years, I mean, the S&P 500 has doubled in the past 4 or 5 years. AT&T is below that. AT&T's former CEO, Randall Stephenson, paid himself more than $90 million. Now, the board sets the pay. I get it. I'm not going to knock the guy for taking something somebody else gives him. The board says, here's a pile of money. I'm probably going to take the pile of money. It's got a $250,000 a month guaranteed pension. I mean, all while shareholders paid the price. I'm not asking you to slam him or the board of AT&T, but what do you think they got wrong? And also, do you think that stock performance makes this new entity less desirable for any new buyer?
Well, I don't think the stock performance in the past has anything to do with where it's going to be in the future. I mean, the market's pretty good at weighing what the future looks like, and I think you're going to have two very competitive enterprises with, by the way, a much more appropriate capital structure for each of them to grow. And in the end, you're going to have growth opportunities, I think, for both businesses. You know, look, I think AT&T's timing was unfortunate. You know, but they were looking at the Comcast model and thought they could pull it off. I think it's probably a testament to Brian Roberts and the job he's done. It's not that easy, and I think that their timing was poor or unlucky, shall we say. Their execution left a bit to be desired on both fronts. Certainly with DirecTV, but the strategy also I think was flawed. And you know, the days of a conglomerate, ITT, whatever, from a capital market standpoint, probably wasn't realistic anyway.
Shepard Smith here. Thanks for watching CNBC on YouTube.